Hey everybody, welcome back. Today we're going to be closing out our discussion on non-bank financial institutions by talking about risk regulation in the shadow banking system. So, without even realizing it, through this entire chapter, we've actually been setting up what is defined as the shadow banking system. So now we're going to talk about systemic risk within it, as well as regulation of the shadow banking system. So, as I mentioned, since 2007, the term shadow banking system has been coined to talk about all non-bank financial institutions since they match savers and borrowers, but they do so outside the commercial banking system. So when you think or hear of the term shadow banking system, this is all that we're really talking about is chapter 11. And they're really important to understand because they usually generally offer lower cost to borrowers and higher returns to savers, but they also have created this huge new regulatory problem because the shadow banking system was proven to be very vulnerable during the financial crisis. So, uh, one of the big issues that you need to consider is that most commercial banking regulation is not used to protect the investors or depositors in commercial banks. Instead, they're used to stabilize the US economy. When the FDIC was created, if you remember, the FDIC is what insures commercial bank deposits. It was created not to protect depositors, it was created to prevent bank runs like what we saw in the Great Depression. And the idea behind that is people will not withdraw their money from commercial banks, even in the time of recession, if they know that it is insured. In doing so, protecting against a bank run. And it does well. Deposit insurance has done a very good job in stabilizing the banking system by limiting the frequency and magnitude of bank runs. But there's no equivalent for the shadow banking system, which, as we've established, is massive and has a ton of influence. And you have to remember that shadow banks rely on wholesale funding instead of retail funding. So there's no real reciprocal or loophole that can translate commercial bank legislation to the shadow banking system. So that means that deposits in like mutual funds, hedge funds especially, there's nothing to protect the depositors, as well as there's nothing to prevent anything like a bank run. And so the one time in US history that we really saw anything like it was during 2007 to 2009 when the Fed guaranteed mutual fund shares against losses with the idea of it doing basically the exact same thing as the FDIC, which says that if I deposit $1 million into a mutual fund, I'm guaranteed $1 million. But the Treasury stopped doing this in September 2009 as the US economy recovered, leaving in place no long term solution to help stabilize and ensure the banking system. And while there are very strict regulations on the type of assets commercial banks can hold, since they were the primary source of periodic financial instability in the 20th century, there's really nothing, as we've established, in the shadow banking system. And as security construction evolved, so we got more sophisticated and complicated securities, regulations did not. It takes a lot longer to pass a new bill than it takes to come up with a new financial strategy or a new derivative or et cetera. And so that means that most modern, like for example, derivatives are not regulated by the SEC or the Commodity Futures and Trading Commission, which, as you can tell by the name, only regulates futures. So anything like CDOs, synthetic CDOs, even swaps, they are completely unregulated by the SEC. And so that means that a lot of the modern shadow banking system is extremely fragile, partially because of how complicated these new financial assets are. And so, because of that, there's just nothing to really ensure investors like, and so what we saw in the Great Depression may happen again. Additionally, this second bullet point is particularly important because there's no regulation, shadow banks have become much more highly levered than commercial banks and can invest in riskier assets in doing so. So that means they're taking on more risk and investing in riskier assets. And on top of it, we don't really know what is even making up the investments in the shadow banking system, since uh, they don't have to disclose a lot of what they do, and we don't understand the actual risk that they're exposed to, because it's very hard to predict the outcomes in certain events. So, for example, we've talked, a lot about the 2007 crisis, but while the world economy just literally came to a stop in COVID-19, the shadow banking system really did very well, except for like money market mutual funds. But like, for example, investment banks, they did extremely well and actually helped out the US government in easing some of the stress from COVID-19. So it shows that we really don't know what's going to just crush the shadow banking system and what's going to leave it pretty unscathed. And it comes down to this fact that we don't understand what they're investing in, and we can't predict the outcomes of certain events and what they're going to do to these complicated securities. And leaving you on that dark note, as well as a little bit of a cliffhanger for chapter 12, which looks a little bit more in depth at the regulation of the entire financial system. You are now ready to take your chapter 11 quiz and then go on to chapter 12, which is the last from our unit on financial institutions, where, as I mentioned, we're going to talk a little bit more in depth about the financial collapse as well as financial regulation that especially spawned from that 2007 crisis.